All right, today we're putting on our detective hats because we're about to solve one of the biggest mysteries in business. We're going to find out how three financial statements, which seem like totally separate documents, are actually just different chapters of the same deeply connected story. So, let's get right to it. Here's the case file by trips up almost everyone. How on earth can a company announce record profits, watch its stock price go through the roof, and then, seemingly out of nowhere, file for bankruptcy? It feels like it should be impossible, right? Well, it happens, and the clues to solving this whole mystery, they're hidden in plain sight. The entire case really boils down to this one central conflict. On one side, you've got accrual profit. Now, this is what the company has earned on paper, based on accounting rules, even if the cash hasn't actually shown up yet. And on the other side, you've got cash flow. We're talking about the actual spendable cash that's sitting in the bank. These two are not the same thing. And the gap between them, well, that's the danger zone, where even profitable companies can completely fall apart. Okay, to crack this case, we need to interview our three main witnesses, the financial statements. Each one tells a totally different part of the story, and it's only when we see how their testimonies line up, or don't, that we can really understand what's going on with a company's health. First up, we've got the income statement. The absolute best way to think about this one is like a movie of the company's performance. It plays out over a specific period, maybe a quarter or a whole year. It's got a beginning, a middle, and an end, and it shows the entire plot of how all that revenue gets whittled down to the final number on the bottom line, the net income. Our second witness is the balance sheet. So if the income statement is the movie, the balance sheet is just a single snapshot, a photo. It doesn't show you what happened over time, it just freezes a single moment, like midnight on December 31st, and tells you exactly what the company owns and what it owes right at that instant. And that brings us to our star witness, the cash flow statement. This is the one. This is the crucial bridge that connects the movie to the snapshot. It explains dollar for dollar how the company's cash changed from the beginning of the movie to the end. It tracks every single bit of cash that actually came in or went out. This is the statement that connects profit on paper to actual cash in the bank. Okay, so we've met our witnesses. Now comes the real detective work, figuring out how their stories connect. This is where we start to see the hidden links, the stuff that financial analysts get paid the big bucks to understand. So here's the absolute key to the whole thing. It all starts with net income. That one number from the very bottom of the income statement, that's the master key. It's the main character that connects the company's performance in the movie to its wealth in the snapshot and its actual cash position. So let's see this in action. Here's the first big connection, what we call the retained earnings bridge. It's simple, really. You start with that net income from the income statement. Then you subtract out any cash you paid to shareholders as dividends. You take that result, add it to whatever you started the period with, and boom, that becomes your ending retained earnings on the balance sheet. Just like that, the movie has updated the snapshot. All right, let's follow a trickier clue now, and trust me, this is a favorite question in interviews. We're talking about a non-cash expense. The classic example is depreciation. So the company records it as an expense, which makes its profit look lower. But, and this is the key part, no actual cash ever leaves the company. So how does this, ghost expense show up on our statements? This is where it gets really cool, because you see this perfect little loop. On the income statement, depreciation lowers our net income. Simple enough. But since no cash actually went out the door, we have to add it back on the cash flow statement. And finally, on the balance sheet, it reduces the value of our physical assets, our property, plant, and equipment. See that? One number hitting all three statements in a totally different way. Okay, this next clue is absolutely critical to solving our big mystery. It's all about the timing of cash, which is what we call working capital. So think about it. If a customer owes you money, that's an asset called accounts receivable. You've made the sale on paper, which is great, but it's cash you don't have yet. So an increase in that asset actually hurts your cash flow. Now flip it. If you delay paying a supplier, that's a liability called accounts payable. By doing that, you're holding onto your cash just a little bit longer, which actually helps your cash flow. All right, detectives, we've gathered the evidence, we've followed the money, we understand the connections. It's time. Let's put all the clues together and officially solve this case. In every great detective movie, there's that one final piece of evidence that just proves the theory beyond a shadow of a doubt. Well, in financial modeling, this is that moment. This is the ultimate check, the thing that tells us our entire web of connections is perfectly and correctly balanced.
So after we've started with net income and we've made all those little adjustments for things like depreciation and all those changes in working capital, the cash flow statement gives us one final number, the ending cash for the period.
And here it is, the big reveal. That ending cash number that we calculated from the movie, the cash flow statement, it has to perfectly match the cash number shown in the final snapshot, the balance sheet. When those two numbers are identical, down to the penny, our model works. All three witnesses are telling the same story. Case closed. So we solved the mystery. Pretty cool, right? But now, how do you use this knowledge to solve your own case, acing that big finance or consulting interview? Let's break this down into your personal prep kit. Okay, if you only remember 3 things from our investigation today, make it these. Number 1, the statements are a team. You can never just look at one in isolation. 2, net income is the connector. It's the bridge that links everything together. And 3, the solution to our original mystery, cash is king. Profit is an opinion, cash is a fact. All right, time for a pop quiz. This is, without a doubt, the most common technical question you will ever get. So seriously, pause here and try to walk through that $10 on all 3 statements. Just talk it out. Remember the loop we talked about. It hits net income, then it gets added back to cash flow, and finally, it reduces your assets on the balance sheet. Now for a more conceptual question, one that really tests if you get the big picture. If you could only have 2, which 2 would you pick? A really solid answer here is the balance sheet and the cash flow statement. And why? Because with just those 2, you can actually build a pretty good version of the income statement yourself. It just shows you how deeply connected they all are.
And for our final question, we're coming full circle, right back to where we started. The answer is all about working capital. The company could be making a ton of sales on credit, which makes its net income look fantastic. But if it's not actually collecting the cash from its customers, its cash flow from operations is going to go down. And that is exactly how a profitable company goes bankrupt. And now you know exactly how to spot the clues.